Well, the bursting of the housing bubble, that helped push the economy into the worst recession since the Great Depression. Now, will housing help lead us out? Bloomberg's Kathleen Hayes is back. She has an exclusive report from Radar Logic that's just been released. Kathleen?
Mark, thanks you so much. And of course, Radar Logic has been releasing its RPX composite index of home prices in 25 metropolitan areas for some time now. President and CEO Michael Fader joins us with a special report which strongly suggests the long-awaited stabilization of the housing market could be upon us. Michael, welcome.
Hi, Kathleen.
Well, let's start by looking at your own index, because we can just show the picture, and if you take that at face value, it seems to show that we've come down a pretty steep hill and now we've reached the bottom.
Well, there's certainly no question, Kathleen, that we've come down a pretty steep hill. In fact, some of what we've observed is that in many of the metropolitan centers we track, housing prices have fallen as much as 50% from their peak. Whether or not that means we've started to rebound is a question that I don't think we'll know the definitive answer to for some time. But it's very interesting to note that as we came into the seasonal upswing that we expect in the early part of the spring in the housing markets, we began to see a response that was positive this year, in great contrast to last year. This time in 2008, the markets were continuing to travel down. This period, 2009, we've clearly seen the index stabilize and in some places improve.
And of course, a stabilizing home price, people think, will help put a floor under the housing market broadly, because people will be more inclined to get in. But another observation you've made, because we're trying to figure out where we're going, is the extent to which you're seeing home prices and the housing market as a leading indicator for the rest of the economy. And you're kind of looking at what happened this past winter with some of these major macro indicators.
Well, I think, you know, we've all been taught that housing's a bit of a lagging indicator. And yet it would appear that housing in the current environment, largely because it's become such a topic of conversation and aggressive media coverage, housing has become center of mind to most American consumers. People who buy houses are not stupid. They're very informed, and they're educated, and they're intelligent. Most markets during the downturn in housing, actual real estate markets, became so stagnant that the silence was effectively deafening. All of a sudden, there begins to be an increase in activity, some increase in prices. We even hear anecdotes about bidding wars taking place in parts of the country. People have to be aware of that, and to the extent they are, perhaps that's helping their confidence.
Is there any coincidence that the stock market seemed to start turning up about the time you started to sense that maybe there was this perhaps bottoming in home prices?
Well, certainly the timing of our noticing it and it happening is coincidental. But there is an argument, I think, Kathleen, that as house prices began to stabilize, as people began to be aware of that stabilization, that perhaps they felt better. If they did, and that took them into spending money, even if it was not on luxury goods, it was on greater necessities. We did see some upswing in retail sales in the spring. If in turn that general sense of perhaps a return to some confidence helped fuel the what we've now seen as a fairly significant rise in the equity indices, then perhaps what people perceive as the core of their wealth, that being their home, will turn out to be a leading indicator.
Let's talk about foreclosures, because the point you have made and what you're showing in your research is that foreclosures are not just something that is sort of pushing the market. You're saying that foreclosures actually are a very big part of the market, and we're looking at the 35% of sales now are basically what you call motivated sellers, distressed sales, foreclosed sales.
That's right, Kathleen. We started looking at the data that we track from the perspective of, was the seller a financial institution or was the seller a homeowner, some time ago. And we refer to the financial institutions as motivated sellers. The Federal Housing Finance Agency released a report last week in which it talked a bit about the different motives for the different owners of homes. A financial institution that's foreclosed on a home does not perceive any benefit of dwelling or benefit of long-term wealth appreciation. They have a cost of carrying an asset that they probably don't want to carry, so they're more motivated to sell. About a year ago, we began to see a distinct bifurcation in the pricing of transactions that were occurring in most cities, where those that we grouped into motivated were occurring at substantial discounts relative to all other. more recently, what we've found is that the motivated prices that we see inside our data have actually returned to what you would consider more realistic levels on a historic housing inflation basis, and that a vast majority of all transactions in markets, whether they're what we classify as motivated or otherwise, are occurring right around those, quote, motivated sales prices. So it may not be so much that foreclosures are still driving the market. It may be that they led the decline in prices because the foreclosed assets were easier to be sold at lower prices, but that they have now found a level at which the market seems to be stabilizing. So it's probably not just the foreclosures leading now. That's probably the price.
Okay, so we want to look at that further because, as we just heard from Michael, this is a key part to the market. In some key regions, in fact, the housing market, like California, distressed sales are playing an especially big role. Back with more on that in just a moment.
We're back with Kathleen Hayes in her exclusive interview with Radar Logic's president and CEO, Michael Fetter. Kathleen?
Mark, thanks so much. And Michael, let's get back to this point about foreclosures and the extent to which in key regions like California, this is what it's not that foreclosures are driving the market. As you were saying before the break, the market's really come to the foreclosure level. But that could be another powerful sign of stabilization. And it's interesting, in the Beige Book, which we just got, the Federal Reserve noted that there was an uptick in home sales in about 2/3 of the districts, and they cited some seasonal factors, low interest rates, and declining home prices as some of the factors. Tell us what's going on in California, and does it sort of tell us what's going on across the country?
Well, as we've been saying for some time, Kathleen, California seems to have been hit first and the hardest. The foreclosure rates accelerated in California well before any other part of the country, and reached fairly significant percentages of total transactions earliest. Prices corrected, if you will, in California perhaps the fastest as a result of the flood of foreclosures. We saw some stability when California declared a moratorium, and that would suggest that foreclosures were playing a big part. Interestingly, we started to see the stability in the markets in California first, perhaps because prices went to the point where consumers were again comfortable, home buyers were again comfortable that, gee whiz, that price is not being overinflated by some financial trade. Perhaps that's a price at which I now can afford to buy a home.
You have some pretty impressive numbers I want to quickly get to about when you look at some of the big cities, L.A., Sacramento, San Francisco, San Diego, again, where you saw huge price declines, that a very large number of the homes being sold now are being sold very close to that foreclosure price.
Well, in several of the major California cities, we're finding upwards of 70% of all transactions are occurring plus or minus one standard deviation from that motivated price. What I think that says is that foreclosures aren't the only transactions, and foreclosure prices aren't the only prices in the marketplace. But in fact, the marketplace has come back into line around the values that's established.
So sad but true, where we got to with these foreclosure prices is maybe roughly where the market should be. This gets me to, I think, what is a very interesting chart you made with a very powerful point, which has to do with, if we looked at normal home price appreciation from around 2000 before the bubble started till now, you say that would be about 3%. What we're showing now is how, with this foreclosure impact, with the bubble bursting and prices coming down so much, it's almost like we're back where we would have been right now, absent the bubble.
Well, I think that's right. Let's be a little careful of what we're looking at on this chart. What we did is we took the Case-Shiller historic growth rates off their 10-city index back from 1987 through 2002, which was presumed to be the beginning of the bubble. We then straight-lined that, if you will, inflation rate in housing through today, and it took us right to where we're seeing prices in motivated sales today. So if it's true that these motivated prices are establishing the new point at which people are comfortable, and we are now back at what would have been a logical inflated price for housing given natural forces, then perhaps what we'll see over the next several months is a real recovery.
Okay, that's what I was going to ask you, but you said it, perhaps a real recovery. We're going to watch for that. Michael Fetter, thanks for coming on today and really laying out all these very powerful forces that are in play.
Happy to be here. Thanks, Kathleen.
Mark, I'm going to send it back over to you.
Kathleen, Mr. Fetter, thanks.